Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome back to another episode of Vantage Point with True North Wealth Partners.
Alrighty.
It's, what is today, Tuesday, May 11th, 2021. Yeah. I'm Andy.
Eric Susie, episode number 11 of May 11. Oh boy.
Yeah.
Good.
There we are again.
Almost a year of producing. That's goes fast when you're having fun.
That's right.
Well, good. Well, I hope everybody's doing well. Spring, a lot of rain here we've had the past few days.
Yes, sir.
Drying out this week, summertime or springtime, so that's good. Grass is growing like a weed. Jeez.
It is.
Well, we got a lot to get into it here today, so a few more charts than normal, but a lot of information to share with you all. So as you can see here with the COVID trends here, the confirmed cases, obviously you'll see India still topping out. It's moving over as far as curling over. Hopefully they're topping out, and that's starts to decline. Brazil's in second as far as confirmed cases, and they're going back down a tad lower now. In the U.S., we spiked out, going down dramatically a lot lower, so we have tapped out. So you'll see that, and then moving on to I think the tracker there, you'll see some other good information too.
Yeah, definitely. Yeah, definitely some good news. It's good that we have seen from CDC. That the infection fatality rate is way down, so it's actually for all ages it's 0.5%.
Yeah,
so if 0 to 17 years old, it's 0.001%.
Jeez, it's nothing.
For 18 to 49, it's 0.04%. Yeah. And it goes up a little bit. 65 and older, it's 3.6%. Wow. So a little bit higher there. Yeah. But overall, combined with all the age groups, it's 0.5%. So yeah, really good news on the at least in the States with the COVID or with the vaccine, and I think too that's probably some of the problems in India and some of the emerging market countries. There's the rollout of the or ability to get the vaccine, and then just how the infrastructure and all that to roll it out, get it out to people. So
takes them a little bit longer.
Yeah,
for sure. Yeah. So I think they also mentioned yesterday FDA approved Pfizer vaccine for children aged 12 to 15. And then also they came out today, I saw a briefing about the U.S. officials say COVID booster shots will also be free to the public. So, yeah, I look at it a little cynically here, but, that's why we have healthcare as far as a sector that we own, money to be made. So it's big money, healthcare, and they're pumping it. So you have to have exposure to it.
Yeah,
so,
T. Rowe Price Health Fund's phenomenal. It's great fun. It's been doing well.
Good. So let's talk about the VIX, because today, the past few days, the VIX has started going back up now.
So volatility.
Yeah. So, so with the volatility, you'll see, the average typically is right around 18, as you'll see on this chart, 18.8. That's been the latest here. But today it's about 22.5, so it has spiked up. But still, nothing to be concerned about per se. We use multiple research folks, but Hedgeye, I was on their call this morning. They mentioned, yes, when it hits 29, if it gets over 29, then that will be more something to watch out for. But right now we're at 22.5. So we're good there. Fear Greed Index, that's another point. Right now, that's showing at 47. Again, 0 to 100. 47 is almost in the neutral, near 50. A month ago, we were at 60 on the Fear Greed Index. So, there's no one particular chart or index that gives you the tail sign like, hey, this hit that, you got to sell out. No. So there's over 50 at least, and none of them are 100% correct. But you just get a feel for the overall view of what things are going on.
So when you say it's on the greed side, that means what, people are buying?
No, they're selling.
Okay.
Yeah. So what's 47 out of 100? So this, people are getting scared, but they're selling, so it goes down. That's the opportunity when you actually want to buy. So it's opposite.
So the lower the number, that's when you want to put money in.
Put money in. That's
I'm just under when it's fear. Okay.
Yep, that's correct.
Right, makes sense.
Yeah. We could be going through another pullback. Well, we have. I mean, you see the QQQ and NASDAQ's pulled in. Last time we've seen that's pretty much been 3 months ago.
Yeah.
February 12th was the market high, and here we are, May 11th. We're about 3 months later. So with that said, Nasdaq's pulled in some, S&P obviously. So you can see a good 5%, maybe 8, who knows? But it's normal. We've talked about that. So
it's good, right? Healthy.
Yes, it is. Yeah. So just be aware of that as well. I'll just touch base on this just briefly. So as far as signs, we're on different calls, research partners that we use as our strategic partners for our research center here. But as far as a few indicators or a couple signs that we do look for as far as entering, we talked about the quads. So quad 1, 2, 3, 4, spring, summer, fall, winter. Currently, we still are in a quad 2.
The show goes on!
So yes, the show goes on for now, but it will move and transition from a quad 2, which is higher growth, higher inflation, to either a quad 3 or 4. The setup is going into a quad 4, which means declining contraction. Which is what we came out of last year. So what I'm trying to say is this: signals of that transition could be happening is when you see commodities starting to fall. You see high yield spreads widen. Right now they're narrowing and they haven't moved even today. They're dead flat. The dollar starts to rise. We anticipate the dollar falling and has been of late. And then interest rates starting to fall as well, and they're not. They're rising. So there's just a few of the indicators, that we keep an eye on as well. So with that, you saw the VIX, GDP Nowcast. Let's take a time out and look back at first quarter. So first quarter, we're about over 90% of S&P 500 companies have reported. This is coming from LPL, one of our research firms that we utilize. With that said, it's remarkable, about a 49% year-over-year increase in earnings, 49%. That's double what they predicted back in the end of March 31st. So, that's incredible as far as, the earnings estimates and being that high. And then they're actually LPL is raising the S&P 500 target range from 4,400 to 4,450 for the S&P.
You mean for the end of the year?
Okay.
Where it's going to be, they think.
Yeah, where they think it is.
All right.
It gets us a target. Every research firm has a dart out there on the wall, and we'll have a transition phase coming later on. So as far as the GDP Nowcast for growth for the second quarter, this came out as 514 from a GDP Nowcasting is one who produces this, and that's the Federal Reserve Bank of Atlanta. And as of 5/14/21, it's 11%. So 11% is the second quarter GDP growth rate, which first quarter GDP growth rate came in at 6.4. So second quarter, we're projecting about 11%. So that's why second quarter earnings are going to be just as great as first quarter earnings. So that's where we're fairly confident in our saying the stance that we're in.
Yeah, it makes sense. Yeah. And going back to, I guess, what you're talking about earlier about the volatility.
Yes.
And the just the different indicators, the signals, right?
Yes.
That we see. And that's really why, that's why you want to be diversified, right? Because
Correct.
you don't know day to day, quarter to quarter,
Nobody
week to
knows.
week, what's going to be in favor, what's going to be out of favor. And so by having, exposure to a lot of things, a lot of different, we call asset classes, in the market, some days everything's going to be up, some days everything's going to be down. Right. Some days some's going to be up, some's going to be down, and it's kind of it's like if everything in your portfolio. You do have the days right where everything's up, but most of the time, some things are going to be up and some are going to be down.
And to summarize what Andy's saying, it's just low correlation. So we have 15 to 20 different asset classes. Some of them are lowly correlated, opposites attract. So that's what we try to do there. So well diversified portfolio is what we build.
Yep.
And then also, I haven't brought this up and waiting for a little while. So this is the first time you've seen this. This is the trade volume chart. So you all know that I track this pretty much on a daily basis. And you can see trade volume right now. We were averaging pretty much the same as last year, but a little over 5 billion trades a day. Okay, that's on the New York Stock Exchange, and billion to trades, 5 billion trades a day. That's been the average. That's the red line. You can see it trending down overall, and it was starting. The first couple months were good, and it started going down of late. Last week, remember you came in the office, we were talking. I said, Andy, we hit 3 billion trades. That's the lowest trading volume. So last Wednesday on 5/5, we hit 3 billion trades. That was the lowest trading volume. Typically, that's called a canary in the coal mine. You've heard me say that before. So we're looking for that, and for the setup. Here you go, Monday, Tuesday, and market volatility.
Yeah.
So where does all this mean? So okay. Well, last year, the trading volume was about 5 billion trades as well. So it's pretty much a wash, the same this year versus last year. But last year, compared to 2019, that trading volume was 3.7 billion trades. So we're up 34% last year versus 2019. So it's always, that's why I track it, chart it. I can see it year over year. You see patterns. And what I'm trying to say is we still have elevated trading volume. So
Sure.
that's the takeaway from there.
Yeah. So what goes? So is that like the 3 billion trades? That's Joe Smith who's at home buying one share of Apple.
Correct.
And that's the mutual funds.
All trades on the New York Stock
Everything.
Exchange.
Okay.
Yep, buys and sells. Yep.
So a buy is one trade. If I sell it, that's the 2.
You got it.
Okay.
Yep. Yeah. So things why we've been sort of, cautiously optimistic, let's call it, is, unemployment. I mean, wage growth. So we'll show a few charts on this, but, unemployment came out, 266,000 non-farm payroll and jobs increase just came out in April here. So that was well below the expected about 1 million jobs. Okay. Now the unemployment rate surprised us, but it rose actually to 6.1% versus 6%. So it did right, just a tenth, to tick higher, but the point is going in the wrong direction. So Yellen, Powell, what they're following is unemployment. They want to see that get lower. Well, if it's going the other way, the pump continues. The show goes on. So
Yeah.
they're going to keep on doing their bond buyings, mortgage back, and agencies every month. So just things that we're following for you. So we're all over that.
Yeah. Yeah. I saw Argus this morning raise their GDP to 8.8.
Yeah.
So, man.
Yep. That's for the year, right?
Yeah.
Yeah, right.
Yeah.
Yeah, I know. So I'm not that aggressive, but it could be. We'll see. All these
great.
these research firms have more depth, and that's why we lean on them. And they're part of our
That's right.
they're part of our team here. So with the wage I was talking about, you'll see on this chart here unemployment and wage growth. So there's 2 charts. So you look at the left axis on the left side. So that's the U3. It's unemployment. That's the one we follow mostly. So it was 6%. This is back on March. But now it's 6.1. But you can go across, you'll see how it's ebb and flow, and it got down to over 15% unemployment during the COVID and what have you. But it's battled back. But 6.1 is where it's at as of today. And then the wage growth. So that's inflation. So people, you can see that's on the right axis. So wage was low. In the 2010, 2011, 1-2%. Then it started going higher, 3-4. Then it spiked up because all the free money, 8% wage growth here, 2020. Right now it's at 4.4% it's wage growth. So that causes inflation. So now let's talk about inflation. So yes, we go shopping, we see at the pump. So things are ebb and flows, but the point is it's out there.
Sure.
And moving on to commodities, which I track in my chart. You see me do that. So the commodities, it's been crazy. So lumber has increased over 350% year over year. Okay, 350%. Housing costs over $32,000 more in lumber costs to build a house. Just for lumber cost increase alone.
Yeah.
That's
yeah.
$32,000.
That's right. My wife said she wanted me to take her somewhere expensive for dinner, so we went to Home Depot.
Nice, I love it. That's great. Here you go, honey. Load up. And in corn, I mean, it's incredible. Corn now, it hits $7.40 a bushel.
Yeah.
Oh my God, I track that. So that's near all-time high.
Yeah, he was buying corn, China.
China, exactly. Yeah.
Yep.
So and copper has gone higher as well, and oil, it's going back up from the lows, artificial lows, and went negative. So at $72 to $74 a barrel is what they're projecting over the summertime. So I'm sure we'll hit that. So my point is this: inflation's here, folks, and no, it's not transitory. So I'll say that to you now.
We thought it might have been, but yeah, it's probably going to be here for a while.
No, it's going to be here. Yeah. The Fed and Yellen, they have a certain agenda, and it's unfortunately a lot of politics that goes on. Job openings, the JOLT report you'll see on this, it's incredible. So jobs right now came out today. Well, you'll see on this report, it's February, the last, as 7.4 million. Okay, well, updated for March, just came out today. It's now 8.1 million. So it's going in the wrong direction. So plenty of jobs.
Yeah.
And there's over 17 million people able to work, but they're not.
Yeah.
And we know why, because they're making too much money staying home.
That's right.
So that's the disincentive. And then you got the child tax credit kicking in July. So it's just pump. So
yeah. And I saw in Ohio too, where they said for the extended unemployment benefits, what they were requiring that you should prove that you're looking for work, which is normally for unemployment. That's how it is. But I think they waived that for the COVID, obviously. And so then now they're kind of reinstating, saying, look, if you're getting this 300 extra bucks a week, we want to see you're looking for work.
Yes. So. No, that's a good thing. Finally. Yeah. Hello.
Sure. Yeah.
You know.
Accountability.
Yep.
Some accountability, I guess. But.
Yeah. And you can flip it around. You mentioned the U.S. economic growth and Argus research. So, you can see the quarter per quarter here. It's minus 31, positive 33. The latest Q1, like I mentioned, 6.4%. And then Q2, should be higher than that as well. But you can just see the past quarter over quarter. And the federal dot plot. So I always like to, this changed dramatically on this latest revision. So the feds, there's 18 Fed members. A lot of them are going to be open seats next year. But this is the dot plot that they think. So for right now, everyone's no rate increases for this year.
Sure.
That's what they've been saying. In 2023, the dots were down low. But now all of a sudden, you're getting a few outliers. A few of the federal feds folks are now saying, hey, we may have to increase it. So you and I have been saying there will be a rate increase next year. So it's going to be sooner than they have to because you're going to have inflation.
Gets overheated.
You got it. So it's nice to see they're getting to reality because which is going to be a slowness in the economy as well as far as next year, trying to keep things in check. So we talked about the volatility, obviously. There was a lot of charts we went through there, but anything else maybe on top of mind for you, or
No, it's just inflation and just the economy getting overheated, right? Where you get too much money, people spending too much money, so it's just kind of basic economics. When you have more money than goods, prices go up. So, but. But hopefully, I mean, I know we're kind of looking at inflation a little bit longer out, but as people go back to work and the economy kind of settles down and gets back to quote unquote normal
economy,
whatever that is,
countries reopening, economies. I mean, people, they finally are realizing you got to open up. So it's for those that do, it's great. So my brother was down in Florida for spring break, and it's amazing. So certain parts are doing very well. Trips of the month. So we know that the cicadas are coming here at the end of May as our ground temperature warms. So we talked about that lot, but just one thing. I was down in Marietta. My wife's uncle passed over the weekend. Well, we had a funeral over the weekend, but article came out. 1.7 million flyers occurred on Friday. The TSA.
Was past Friday?
Yeah, it's past Friday. Right. So that's the most it's been. So that's great since March of 2020. So that's the direction we want to see. People getting out there, moving around. So that's good news. With the restaurant industry, travel industry, we track all that. Gas utilization's up. And another one here, the census is redone every 10 years. So the 2020 census, which captures the previous 10 years, so from 2010 to 2020, last week, this is coming from Hedgeye, from a demographics. Last week, the census released its decennial population numbers. Results were the U.S. population increased a positive 7.4% to 331 million people, 331.5 million people. That marks the weakest rate of increase since the 1930s. So yes, we increased over the past 10 years in population to 331 million. But as you can see on this chart, it is the weakest since the 30s and 40s there, 7.3. So, and then we talked, you have to have, immigration, but legalized immigration and, policies and that all good, foreign tax,
Yeah.
all this stuff that's coming down. So the markets will be, listening and making tactical decisions to that, and so will we. So.
I guess you'll have to have a few more kids.
Yeah, well, we're done. Yeah, I know you are too. Jeez. We're too late,
Have those
right?
babies. Yeah. I mean, well, it is a concern, right? You have people,
Yeah.
they're getting married later in life. They're not
Yes.
having kids right away. So it's, you don't think about that, I guess. It's just the ripple effect that
right.
it has on a society, on a
That's why we look at
Civilization.
multi-factors, right? There's a lot that goes into this. It's just not one thing. So
yeah. And there's other things that aren't economic that go into
Right.
that too. But yeah, it's something to be,
yes.
yeah.
We'll
something
have
to look
Nathan,
at.
our producer. He'll take care of it. He'll have a couple more kids.
He'll
He's
populate.
younger than us, right, Nathan?
He's got more energy.
Yes. Well, I think that's it for this episode, number 11. So we appreciate you. Stay well. Get out there. Enjoy the country, springtime, your family. And we appreciate you. Reach out to us. Any further questions you may have, concerns about anything. But we're all over it, monitoring it. We'll tweak the portfolio. You may see some here over the next month or two. But for sure later on in the summer, there'll be a bigger one. But thank you.
All right, guys. Thank you. Have a good day.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.